Our next guest is the head of investment research for the world's largest hedge fund, that is Bridgwater Associates. Karen, thank you so much for joining us.
Thank you so much for having me.
Yeah, so I got to get your take, because you are heading up the research at the world's largest hedge fund. What is kind of your view right now when you look out at the global economy? What are you kind of paying attention to at the moment?
Well, I'd start with the fact that it's probably the first time in well over 40 years that a very low unemployment rate is not a reason for the Federal Reserve to raise rates. I mean, there's a reason why cycles usually end. The most dangerous thing typically for an equity investor is at what point does the Federal Reserve decide now's a good time to cut off the cycle.
Right.
And usually when no one is looking for jobs, everyone is employed. That's a good sign that excesses are likely to start emerging, whether it's inflation or other things. And that's not really happening. You have a huge, massive debt overhang, deflationary overhang that's really weighing on things. And so now we're in a very different environment where that kind of normal cycle where the Fed cuts it off is not what's going to operate. And there are a whole set of different risks than we've experienced before that are much more about how the internal conflicts within countries and the external conflicts between countries are going to be resolved. And that is really where the risk lies for how the cycle is likely to end.
Karen, in terms of stock valuations at these levels, does it make sense to you?
Well, I'd say the United States is a lot more stretched than anywhere else in the world. And the United States is really where you've had over a decade of outperformance that has matched the fact that the United States came out better out of the financial crisis than any other country. But at this point, when you look at U.S. profit margins, they're the most stretched that you see anywhere around the world and very vulnerable to reversals on issues like antitrust, regulation, generally relations between labor and capital, strength of labor unions. You can't really get another leg down to be as supportive to companies and their profit margins as you just did with the tax cuts. Antitrust can only go from high to zero, whereas the risks of a reversal of pressure on those profit margins is much more significant, and that's really greater in the United States than any other country.
Karen, I also want to ask you, because we're just off the heels of the Phase 1 trade deal, what does that mean for not only the U.S., but other economies? What are you seeing there?
Well, I'd say at the highest level, we expect that the U.S.-China set of conflicts is going to be with us for a very long time. And so this Phase 1 trade deal doesn't take the broader set of issues off the table. But in the near term, what's really interesting about what was actually agreed to is that pretty much if China is really going to do its part and buy more from the United States, that means buying less from somebody else they buy from today. And the most vulnerable countries to that are really its neighbors. China imports disproportionately from its neighbors. So as we look around the world, there's really a set of countries, mostly in Asia, where we think it could be as big as 0.5% of GDP hit to make that switch.
What's one of your big calls for 2020?
Well, that's a very broad question, but I'd say probably the biggest thing we're talking about is that the divergence between kind of classic way of measuring the economy, what central banks have always looked at, and social, environmental, what are the quality of life indicators, is just becoming too great, and it's going to have to be resolved. And the question is, how will it be resolved? Orderly, disorderly, a lot of different ways to resolve it, but that divergence is just becoming too great, and that's why you're seeing all of the internal conflicts.
It sounds as if you're saying, or maybe saying, the Fed is out of touch.
Well, I think the Fed is doing the right thing and saying, this is not a time to be tightening in to a strong economy. Partly because the growth we've had has not been equal. You have a huge wealth divide and a lot of inequality, and there are no excesses. It's not a great time to be tightening.
I was wondering if you could actually unpack that a bit more, because that was interesting. You're just saying that some of these quality of life indicators, unpack that for us, because it seems like, yes, in the U.S., we have such disparity between wealth and inequality. Can you talk to us a bit more about what you're focused on as it relates to that?
Well, we're really focused on measuring what are the issues that are kind of hidden in the macro statistics, because there's a long history, 40, 50 years, where pretty much if you saw GDP growth, quality of life went up. That was a very good approximate indicator all around the world. If GDP growth was up, quality of life went up. And now, with the fact that GDP growth is so low, and there's secular reasons behind that, and we expect them to persist, there's not going to be strong enough growth to sort of grow us out of the social and environmental problems people are experiencing. So we're looking at issues like falling life expectancy in the United States, income inequality, wealth inequality, quality of health and education services, environmental degradation, things that are weighing in to people's perceptions of how the economy is doing that then translate into a very divisive set of politics and then policies that will affect the markets.
One of the buzzwords floating around the World Economic Forum are green swan events. Is that a real thing you're talking about inside the company and investing alongside?
Well, we feel that policy and the markets are going to move faster than actual changes in the world. And so if you look at something like how great are climate change risks for a certain economy? That could take decades to play out if things aren't done. But in a very fast turn, a change in policy can cause a major shift. And we've seen that when, standards change on cars and emissions. Very quickly, a whole industry has to readjust. So those are the kinds of things we're looking at to see what policies are going to be carried forward, and then what will the second and third order effects be.
One final question. What do you think the status of the U.S. dollar is going to be going forward?
Well, the U.S. dollar has had such a dominant role in the global financial system for so long that it can't get stronger. And at this point, the United States has really showed its willingness to use the dollar as more of a political tool. And so certainly there are risks long term, and we're seeing more and more countries start asking themselves, how concentrated do I really want to be in dollars? That said, not that many global alternatives today that are as viable. So over time, the role of the dollar is undoubtedly going to fall.
Karen Karniol-Tambour, the head of investment research at Bridgwater Associates. Really great stuff. Thank you so much for joining us.
Thank you.